Okay, so let's talk about a week of absolute chaos in the Nifty 50 market. This is a story about a high stakes showdown between raw human emotion and the cold, hard logic of an AI. And what happened? Well, it might just reveal a fundamental shift in who or what is really in control of the markets.
And that really gets to the heart of it, doesn't it? What happens when the story that human traders are telling themselves just completely collides with the mathematical reality that only a machine can see? That's exactly what we're going to unpack.
So, our story kicks off here, in Act 1. Now, on the surface, everything seemed, well, pretty calm. But underneath it all, this immense pressure was building, coiling up like a spring, just waiting for an absolutely explosive move.
Let's walk through how this whole trap was set up. So, on February 16th, the market takes a nosedive, but then it gets bought back up surprisingly fast. This creates what traders call a wall of worry, that shaky, uneasy feeling during a recovery. Then, the very next day, the market goes dead quiet. Volatility just dries up. But the trading volume is still high. Think of it like a coiling spring. All this energy is getting packed in with nowhere to go. And then, on the 18th, comes the final piece of bait, a really tempting price gap at the open, basically daring people to jump in and buy.
And that, of course, brings us to Act 2, snapping the bear trap. This is the part where the AI starts to see right through the illusion. It looked at the market's apparent weakness not as a sign of collapse, but as a perfectly laid trap that was just about to snap shut on the unsuspecting. This right here, this was the moment. On the morning of the 18th, the market takes another sharp dive. Now, for human traders, this looked like the final confirmation. The breakdown was here. Panic starts spreading like wildfire. But for the AI, this wasn't a crisis. This was the moment of maximum opportunity. And this number, it just shows you how intense that fear really was. The AI's internal bias score, which is basically its gauge for market sentiment, crashed all the way down to -18. I mean, that's not just bearish, that is extreme wall-to-wall pessimism. But right at that exact moment of peak human fear, the AI saw its opening. This quote is really the key to the AI's entire logic. See, it wasn't trading the popular story, the narrative of a market collapse. No, it was trading the mathematical reality, an extreme level of fear that was statistically very likely to reverse. It had the conviction to bet against the entire crowd, precisely when that crowd was most certain it was right. And here is the visual proof. The system calls this the cloud twist. You can literally see the red cloud, which was pressing prices down, just give way to this expanding green cloud from below. For the AI, this was the unmistakable, non-negotiable sign. The trap had snapped, and the market's entire direction had just flipped on a dime. But just when it looked like the bulls had scored a massive win, the market delivered a brutal reality check. Act 3 brings us a sudden, catastrophic collapse, a true black swan event that pushed the AI's logic to its absolute breaking point. So the very next day, February 19th, the market didn't just dip, it imploded. We're talking a nearly 500-point freefall. This wasn't just a bit of volatility, this was a black swan, a true structural breakdown that completely changed the entire story of the week. Just look at this chart. That one single, massive red candle wiped out 4 days of progress in an instant. All of that market structure that had been so carefully built up, gone, obliterated in a matter of hours. The damage was just immense and immediate. So how on earth did the AI survive this catastrophe? In just 30 minutes, it performed a perfect pivot. It started the day feeling pretty bullish, right? But at the market open, it spotted something called an identical tick, a very subtle signal that often points to a trap set by big institutions. So what did it do? It instantly threw out its old forecast, aggressively flipped its bias to completely bearish, and then tracked 14 sell signals in a row on the way down. It was pure, emotionless adaptation at machine speed. So after that crash, the market was basically left for dead. But the AI wasn't done. Act 4 is all about the mastery of chaos, how it navigated this violent V-shaped recovery, not with hope or guesswork, but with the cold, hard logic of structural anchors. Okay, so on February 20th, the day after the crash, the market opens with another devastating drop. This time, the AI's bias score hits -19, even worse than before. This was the moment of total capitulation, when everyone just gives up and sells. It looked like the absolute end. This chart shows the AI's methodical response. Think of it like a temperature check. It starts at that extreme fear level of -19. But as the market starts to recover, you can see the AI gradually neutralizing its own bias, moving it back toward the middle, eventually bringing it to a perfect 0. A 0 score means the market is balanced. The fear has been completely drained, and the panic is officially over. And I want to be clear, this V-shaped recovery wasn't some lucky guess. The AI orchestrated this entire 283-point climb by anchoring the live price action to known historical levels. It understood that this violent bounce was simply a reversion to the statistical mean, a return to a known point of balance, not just some random act of market madness. So the big question is, how did it pull all of this off? Well, in our final act, we're going to pull back the curtain on the AI's core architecture, the secret weapons that allowed it to not just survive, but actually master this chaos. The AI's logic really follows a pretty straightforward 4-step process. First, it ingests a complete fire hose of market data. Second, it processes all that data, filtering out the random noise to find a clear signal. Third, the intelligence layer uses neural nets to analyze and, think. And finally, a control layer acts like a strict supervisor, making sure the AI follows a deterministic set of rules, no matter what. First up is something called the MCP, or Model Context Protocol. The best way to think about it is as an invisible conductor. Its only job is to focus on the big picture, the true daily trend, and completely ignore all the short-term noise. It's like listening to the whole orchestra instead of getting distracted by one frantic violin. This is what kept the AI from getting faked out and panicking. Next is RAG, which is essentially the AI's long-term memory. See, most trading algorithms only see what's happening right now, in the present moment. RAG solves that problem by constantly injecting critical historical data, key price levels from the past, into the live analysis. This is how the AI knew that V-shaped recovery wasn't just random, it was simply a return to an important historical price level. And finally, there's the adaptive cloud. This is the visual filter that translates all of that complicated math into a simple command. Red means it's a no-go zone, a suppressive environment where it's just too dangerous to trade. Green means it's a go zone, a supportive environment. It's how the AI can recognize instantly, just by looking, when the entire game has changed. And all of this leads to a final, pretty critical question. In a market that moves at the speed of light, a market where AI systems are proving they can navigate chaos better than we can, is our role fundamentally changing? Maybe we're no longer the decision makers. Maybe we're just becoming the architects of the machines that decide for us. Something to think about.